my thoughts on today's sell-off. You know, I get a lot of great tweets each day, but today, I think the most profound one I got in the midst of all of this massive selling that is obviously exacerbated by selling programs came from David Hudson. He said at CV Payne, when are we going to ban algorithm tradings? Algorithm acts like an automatic auto-reply email setup talking to another auto-reply email account. It creates an avalanche of emails, but zero communications. Questions about the use of machines and programs and pipes built next to exchanges have frustrated the investing public for a long time. Remember Michael Lewis? He created a firestorm with that Flash Boys book. And more recently, the need for instant success has superseded the art of investing, turning many professional money managers into momentum chasers. They chase the momentum to the upside, they chase it on the downside, or bail out on the downside, or should I say it's the machine and the robots that do all of the chasing, and sometimes at the speed of light. Now, the issue, coupled with the removal of the uptick rule, makes uncertain periods of the market much more dangerous. In fact, people are coming around to now asking why the SEC ditched the so-called uptick rule. It was created in 1934, and it was designed to stop the indiscriminate destruction of stocks by operators who knew just the right amount of nudging could trigger panics. Essentially, a stock had to tick higher before a short sale could be executed. Well, the SEC removed the rule on July 6, 2007. That's right, just in time for the second worst sell-off ever. Coincidence? Now, the SEC put in a modified uptick rule in an attempt to curb shorts, but this after a stock is down 10%. So let's face it, that's really a joke, maybe even an insult. So now is it time to consider prohibiting algorithmic trading or even putting in curbs there somehow, and then also to bring back the uptick rule? I want to bring in Money Map Press Chief Investment Strategist Keith Fitz-Gerald. Keith, I know we're talking about two things, but they both seem to have the same impact on the markets. Selling gets crazy. Down 100 in a blink of an eye becomes down 600. What are your thoughts? First, let's talk about these algos, these algorithms.
Well, I think there's one other thing you got to add to that very prescient email. You got to add the shift from fractions to decimalization, because now you've got huge amounts of leverage chasing pennies. And if you add computers into that mix, it becomes a fire sale. The only question is who's bought the gasoline. I think the regulators are asleep at the switch. Wall Street likes it that way because they make billions on high-speed trading. And investors, of course, are left out in the cold, and they're the victims of the fire sale in this case, especially on days like today and what we had on Tuesday.
What do you say to those who say, hey, listen, all it does is, speed up the ultimate, inevitable process, and it helps with price discovery, so there's an actual role for something like this?
I disagree with that statement, and I'll tell you why. Because high-speed trading engenders technical momentum chasing that has nothing to do whatsoever with the fundamental underpinnings of capitalism, namely the creation of value. Here, and you throw in ETFs, and I want to bring this up, this is an important point, because you've got huge blocks of passive investors that are now forced to realign when the computers do their thing. So it's a double whammy, and again, I think it's time it needs to be regulated. It certainly needs to be looked at, and unfortunately, you're not going to get the regulators to do it because they like it.
Of course, some skeptics might look at this conversation and say, these guys never complain about algorithmic trading or algos when the market's going up 500 points.
Oh, yes, we do. Yes, we do, because it complicates the analysis. You know, the realistic component of capitalism is that you bet tomorrow will be worth more than today. And you place your bets accordingly. And that comes down to, does the CEO know what he's doing? Does a company make good products? Are there good services? How do you value the cash flow? Those are all things that actually create value in the economy. If you're talking about decimalization and high-speed trading, you're talking about creating value for a few specific individuals at the expense of a far greater number of people. I would submit anybody who wants to criticize this, take their best shot, because I don't think fundamentally they've got a leg to stand on.
What about the uptick rule, Keith?
You know, that's a controversial one. I'd like to see it come back. It existed successfully for a long period of time. I'm not sure, frankly, how that would work with computerization, but it seems to me now's a pretty good time to revisit that issue.